Hello and welcome to the Finance Quarter. I'm Andrew Robertson. As we all know, banks have been raising their variable home loan rates at a time when some fixed loan rates are falling. And that raises the issue, if you're paying off a house, do you stay variable or do you lock in a fixed rate that's lower than the variable rate at the moment? I put that question to Suzanne Haddan, who's the Chief Executive of BFG Financial Services. Suzanne, with variable mortgage rates going up and some fixed rates still going down, the temptation is to lock in a fixed rate. What are your thoughts on that?
Look, it is tempting, but it's really important to consider your whole circumstance in regard to the loan, because as you know, there's advantages and disadvantages to fixing a loan.
And one of the disadvantages with fixed rates is there's lots of conditions around them, aren't there?
Yes, there's significant restrictions with most fixed loans. First of all, they generally have what we call break fees. And that means if your circumstances change and you want to renegotiate or change your loan, depending on where interest rates are, there's generally a cost. Also, there's restrictions on, say, you wanted to make extra repayments on your loan. Sometimes you can't above a certain level. And lastly, the common one is the offset accounts. You know, when you put money in a savings account to save interest on your loan, there's often restrictions on that facility as well.
And that restriction around making extra payments, I imagine, is a big one in the current climate, because variable rates have come down so much and most people just leave their payments as they are. So most people are actually paying more than they need to now, but you lose that, as you noted.
And that's a great strategy, a financial strategy, to get ahead on your mortgage payments when things are low. And the other disadvantage is it actually locks you into a particular institution. I mean, we're turning over our loans every few years to get a better deal. You get a fixed loan, over that period of time, it can be very difficult to change to another institution for a better deal.
I've seen studies that suggest that in the long term, staying variable, you actually pay less. What are your thoughts on that?
Well, if you just look at the interest rate, it's over the 20 years, it's sort of 50-50. It's neither win or lose. But the problem is it doesn't take into account the issue you've raised about putting extra money into the loan and the interest you save on the loan that you couldn't have done if you had a fixed loan over that period. So having the flexibility should not be underestimated. I mean, people's situation changes. Think about couples that have a loan and then might be planning a family. They want to get ahead on the loan. Well, the fixed loan, they're a bit stuck for that period of time.
Everything I've heard you say, without saying it in as many words, seems to me to be saying you should stay variable.
My general view is shop for the best variable package you can. Be careful when you're shopping around though. Have you heard of the term comparison rate? It doesn't always exactly match your loan, the size of your loan and the various features. So certainly look at the interest rate, look at the comparison rate, but look at the general fees.
Well, you've raised comparison rate, so you better explain what it is.
So a comparison rate is what the government introduced to try and enable the consumer to be able to compare different types of rates, because it includes known fees, not just the interest rates. But the issue with the comparison rate, it doesn't cover costs that might be one-off events that aren't sure to happen, like breaking the loan, because that's not a guaranteed cost, that's a choice you make. So be careful with the comparison rate, but still have a look at it and then look at your total options, like does it have an offset account and other facilities.
Variable rates are so low at the moment because the cash rate is so low, and on the balance of probability, there's really only one way they're going to go, which is up. Are we in a unique situation at the moment that should make fixed rates more attractive?
I think the important thing to remember is when you're looking at fixed rates, you're also then taking on the bank or the financial institution, because they're not going to set a rate that means they might lose money on the deal. So on average, you would expect you wouldn't beat the banks at this game. Having said that, I agree with you on the probabilities. We mainly lean to rates staying where they are or going up, but they still could go down. And one of the options you have if you want to take an each way bet, because that's what it is, it's a gamble, it's just which team you're going to gamble on, you could fix some of your loan and have some variable. The problem with that is it still locks you into the institution, because if you've got some fixed, you can't just move the variable part, can you?
Suzanne Haddan, as always, some great advice. Thank you for your time.
Thanks, Andrew.
When times are tough in the business world, the temptation is to lower your prices to sell more of your product or service. Just walk through any shopping centre and you'll see many stores having sales. But do sales or discounts add any value to your business? According to small business expert Julia Bickerstaff, the answer to that is usually no. Julia, you're running your own business, conditions are tough, there's lots of competition, you want to sell more of your product, so you decide to cut your price. Why is that the wrong strategy?
Well, it's very tempting to do it, but it's often the laziest thing that you can do, but the thing that we think first about because we see it done everywhere. I guess there's two very important things to think about. The first one is that every time you drop your price a little bit, that is a direct hit on your bottom line, and you can very easily go from as simple as a 1% price decrease can have a sort of a 10% knock-on effect on your net profit. The second point, though, which is also very important, is you could say, well, I'm only going to do a little discount, but when we start to train our customers to expect lower prices, it's very hard to put them back up again.
So even just to stand still, if you're discounting, you've got to sell a lot more product.
Well, you do. I mean, it's interesting. You can run some numbers on these things, but as an example, a business which makes a 40% sort of gross profit margin, they'd have to sell another extra third, another 33% on top to have the same profit again. So you sort of think, oh, look, it's just a little 10% discount, but actually, I've got to sell the same amount plus another third just to be where I am already.
So when conditions are tough and there is lots of competition and you want to boost sales and boost profits, what do you do?
Well, I think the first thing to think about is just on the discounts is if conditions are tough and you've got stock that won't move otherwise, then that is a good reason to discount, just to get it out so you can turn it into something useful. But if it's just, conditions are tough and you're using it as your sort of marketing, then other things like, getting very good at customer service, really thinking about your customers and what they want, what other products or bundles of products will be better for them. How can you differentiate yourself from your competitors without changing your price, but creating a sense of value for your customers? Our customers, can sort of change their views on what they want. So if you're finding that you're feeling like you're having a bit of a decline, it could be that you're not caught up with actually their changing desires.
So differentiating yourself from your competitors by focusing on your customer rather than focusing on price, because focusing on price is just a race to the bottom, isn't it?
Depending on what you sell, and if you sell a pure commodity which is identical to everybody else's, then completely identical, then people will just go for the bottom one. But the interesting thing about price, for most of us consumers, we don't actually know what the quality of a product is. And we shortcut trying to work out the quality by looking at the price. So if I've got three things lined up in front of me and I want to have a good quality one, I will buy the more expensive one because I think that must make it quality. So the opposite to that is if you're busy discounting and making your prices lower, you're sending a signal out to customers that actually you've got a low quality product.
Julia Bickerstaff, as always, great advice. Thank you for your time.
That's a pleasure.
And now for the second part of our interview with recently retired Telstra boss David Thodey. In the first part, Mr. Thodey explained that focusing just on profit is a great way to kill your business. And if you'd like to see that interview, just go to the ABC website and type in Finance Qtr. Today, Mr. Thodey urges small business to embrace the internet, pointing out that there are big risks if they don't.
The reality is the internet has changed the way we all live and conduct business. I mean, it's just a reality. And what's very important is to understand that rate of change of technology innovation is accelerating, not actually declining. So I would encourage any business owner to understand those trends, see how you can use it to your advantage, not be disrupted by it, because value chains or supply chains are getting shorter and shorter. People are buying on the web where they never used to before. But it's more than that, it's how you can change the dynamics of your relationship with your customer using the internet or other digital technologies.
Just following on from that though, of course Telstra was very fortunate in that it could monetise the disruptions to its business, such as mobile phone calls and then internet data. but there are many businesses that can't, such as, or that are struggling to, such as newspapers, such as many retailers. I mean, what do you say to them?
Well, I would probably challenge them more to say, yes, it may be different to what you did before, but there's still opportunities there. And not to feel threatened by those changes, but to adopt the new innovation. What I find is often people are so concerned about holding on to what they did in the past rather than looking what they're going to do in the future. And I'd put to you that whether it be in media or in the music industry, all these industries have been enormously disrupted by technology, but there's new business models out there that you can adopt and use.
Small business owners watching this might be thinking to themselves, well, that's fine for Telstra, it's a really big company, but I just run a very small business. Why is everything you've said today relevant to small business?
When you're on the web, nobody knows how big you are. It's about the service or the product you offer and how you do it. So look for the opportunity. I don't think it's about size. I don't think size has got anything to do with it. It's about innovation. It's about understanding trends and about being bold and believing in your convictions to make a difference. And if you find that, then you can go out and you can be a small business in somewhere in regional Australia, but you can take over the world.
David Thodey, some terrific insights there. Thank you very much for your time.
Thank you.
Well, that's all for this edition of the Finance Qtr. As always, if you'd like to see any part of the program again, you can find us on the ABC News website. Just go to the business page and click on the Finance Qtr icon. Thank you for watching, and we'll see you next time on the Finance Qtr.